In topic number 6, we are going to look at what we call product costing. So here, we are going to deal with physical goods and also services, whereby a company is offering services. Maybe we have a circle or a matatu. So here we have maybe three. They have three vehicles. They have three vehicles here. The three vehicles, you'll be told that each was purchased at a cost of 5 million. Each will be depreciating at the rate of 10% on cost for the whole year or per annum. These vehicles here are going to cover, let's say, 1,000 or even 50,000. Let's talk about something of that kind, maybe kilometers, for example. And for every kilometer covered, they are going to consume fuel. So you tell us the fuel that will be consumed by these vehicles for the 550,000 kilometers. These vehicles are going to have what we call maybe insurance. They're going to take insurance cover these vehicles. So you're going to have fuel consumption. Here, you're going to employ drivers who will be paid at the end of every month. You're going to pay drivers. These vehicles here, you must do repair and maintenance or even service. So let's talk about repair, maintenance. These vehicles here, you must have an office or rent and rates you're going to pay, things of that kind. And then from all these expenses that you've listed, you'll be able to see that maybe out of these three, one is a 15-seater, another one is a 13-seater, another one is 11-seater vehicle. So all these vehicles here, for every, or in 1 month or within, every time they're going to cover 1,000 kilometers. Anytime they cover 1,000 kilometers, they are going to charge, the company will be charging these passengers here a fee of about, let's say, 800 shillings. So the 15-seater will be charging 800. 15 people will be charged 1,500 or 800 per trip. Maybe this 1 kilometer, okay, that's the entire one is 50,000 kilometers. Then, so each will be covering. So here, this is per kilometer or for every 1,000 kilometers. So here we have 50,000 kilometers, which means we are going to multiply that by 50. The 13-seater, you are going to do the same. You are going to do the same. Whatever you're going to get here, the figures you're going to get here represents the total revenue or sales. When you come to this part, there are those costs that are directly related to the service these people are offering. For example, you'll only consume, the vehicle will only use fuel if you are having passengers. This one will be depending on the distance covered. So this one we are going to call it as a variable. It is directly related to the service we are offering here or the cost of offering that service. This insurance, maybe you are taking it once in a year, it is fixed. Whether you are going to use the vehicle on a daily basis or not, it will be fixed. Repairs and maintenance, of course, you are going to do this a fixed amount, maybe. Rent and rate, the office, maybe you've taken a lease, so you are going to pay fixed amount for a given period of time. The depreciation here is fixed. So we're going to classify all these fixed costs maybe and classify them into overheads. You classify them into overheads here. Then you also bring the variables costs together and use the suitable method to apply when dealing with this variable, such that, for example, here, The variable cost here is depending on the kilometers that are covered. So just consider the kilometers, then you look at it. At the end of the useful life of these vehicles, they can be disposed at a scrap value. The scrap value of these vehicles may be the 15-seater can be, let's say, 2 million. It's 5 million, let's say 500,000. Then the 13-seater can be even 400,000, something of that kind. This other one can be even 150 or 200,000, something of that kind. So you will have to also to look at the benefit you're going to get, the terminal cash flows, these ones here. You also add them back to be as benefit, the total income you're going to receive in handling this particular business for this maximum of 50 kilometers. So that one, you are dealing with a service. And from bringing all these costs together, by bringing all these costs together, you can also decide to set your price. Is it your fare, the amount you're going to charge these people? How much will it cost you to have 2 passengers from here covering 1,000 kilometers? That's what you need to look at. And then you multiply by, or you now bring in your markup or margin for you to be able to know the service per passenger, the service charge per passenger. That is now in the service industry. When we come back now to goods, a company is bringing in timber. A company is bringing in timber as the main raw material, So this timber, maybe you have 40 feet timber. Having brought this, you're going to bring in additional items. Here you need nails. Here you need nails. Maybe you need other items, but also you're going to pay for labor. You're going to pay for labor here. We're still within that process. You're going to pay for rent and rates. If it is a business, you need maybe license or business permit. Having done that, you need other overheads, maybe. So here we have timber as the main raw material. This timber will determine the size of the table. So here, this timber one, it can be used to produce table. It can be used to produce chairs. It can be used to produce stools. Now here the company can decide to produce 3 pieces of tables, 3 pairs of pieces of chairs, and then 5 stools. The cost that has been incurred here, is, let's say, 5 million. What strategy is the company going to use to distribute this 5 million cost to these items, keeping in mind that we've only produced 3 tables, but maybe the tables require a small piece of timber compared to chairs, something of that kind, or the other way around. They still require a small piece of timber to prepare. So how will I apportion this cost? Which basis am I going to use? For us to understand that, we have this basis for the allocation of the cost. We can use net realizable value. We can use units of output. Then we can use sales value as the allocation basis. So if I use units of output, I have a total of 6 plus 5 is 11. So tables will take 3 over 11 times the cost to be shared. Chairs will take 3 all over 11 times the cost to be shared. And stools will be taking 5 over 11 times the cost to be shared. That is units of output. Net realizable value is the total sales less additional processing costs. So this is how we get net realizable value. Net realizable value is equivalent to total sales less additional processing costs. After that, anytime you're going to do production, there are these terms we are going to use. In the process of doing production, if everything is perfect, you normally expect that the type of raw material you are dealing with, for example, here you are dealing with petroleum. Petroleum. This petroleum will be used to produce, let's say, kerosene, diesel, and then maybe we have super or leaded petrol, something of that kind. Now, here, it is not that the 20 liters of the petroleum brought in, will be used to produce all the liters of these particular items. No. What will happen? For example, here, you are going to find that kerosene, you have 5 liters. Diesel, you have 12 liters. Here, you only have 2 liters. And then this one here, you have 1 liter, you have 1 liter. Let's say we have these ones here, 2. So it is 5 plus 2, 17, plus 2, 19. But you brought in 20 liters. 1 liter is missing. This 1 liter can be missing based on these factors. One, we can have what we call normal loss. Every time you bring in petroleum to be processed, 10% is lost under normal circumstance. And if it is going to be lost under normal circumstance, it can be due to evaporation or pilferages. Due to evaporation, when you're going to eat it to come up with these products, there's that quantity that's going to be evaporated. You cannot recover it. So that is allowed, the normal loss. But then you find that we have abnormal loss. Yes, here we expect 10% to be lost, but at the end of it, we are finding that the company has lost 20%. So 10% is under normal loss. Another extra 10% is going to be abnormal loss. This abnormal loss could be due to some factors here. If it is going to be lost, it could be due to inefficiency of staff. Here, machine breakdown, which will lead to regular stoppage. Then we have lack of adequate skills. For example, you brought in somebody who is learning. The rate at which an expert is going to deal with a given task is different from the rate at which an intern who is interacting with that job for the first time is going to do the same job. They're going to do it at a slower pace. And if they're going to be in the manufacturing department, the rate at which they're going to do their production maybe will affect the quantity to be used in the production of the same product. And therefore, it will lead to what we call abnormal loss. So these ones here, if it occurs, the abnormal loss, it must be part of the product cost. It must be part of the product cost. We cannot use this as an expense to reduce production cost. But this one here is allowed. This one here is allowed. This normal loss is taken care of the company, and anytime they are going to do production, they say we have brought in 50,000 kgs, they know 10% will be lost under normal circumstances. So should they have a loss that is more than 10%, the excess will be the abnormal loss, which will be able to form part of the product cost. So how do we get the product cost? Product cost is equal to total input or total costs of inputs divided by expected output. So total input cost, we have to deduct normal or scrap value. Let me call it scrap value of normal loss. And expected output will be basically be total units, total input less normal loss. Less normal loss. Let's see. If normal loss is expected loss, how do I define abnormal loss? You can see the hidden part is the excess of normal loss in the results of abnormal loss according to my Under normal circumstances, you've said that anytime you bring in raw material, we expect to be losing 10%. So if I reduce 50 kg by 10%, it means I need to get my expected output. My expected output will be 90% of any input I'm going to bring in. Will be 90% of any input that the company will be bringing in for production. Will be bringing in for production. Now, the abnormal loss, you expect that you are expecting 90% to be the results as part of the output, but in the process you only get 85%. You've lost a total of 15% for you to arrive at the 100% which was brought in. This 15%, you know very well that 10% is the normal loss. So here, mtu anasema haoni board. Mtu anasema hawezi kuona board. Is it true? Is it true that my board is not visible? Please confirm. Confirm if my board is not visible. Are you able to see my board? Check on your network. Visible. Okay, check on your network, please. So that's what you are going to have here. So the extra 5% which was lost is due to abnormal loss. Is due to abnormal loss. Is due to abnormal loss. Total cost of input less scrap value of expected output. And expected output is total input less normal loss in terms of units. Normal loss in terms of units. Now, it is the other way around. The company expects that every time they bring in raw material, they are supposed to lose 10% in the process. They're supposed to lose 10% in the process. But now, instead of losing 10%, that is having 90, they found out that they have 95% of what was brought in. 95% of what was brought in. So they expect to lose 10%. But here, they have only lost 5%. So what has happened? There's what we call abnormal gain. Abnormal gain has occurred. Formula ya products, that last part can't be seen. Hapa tunasema ni total input less normal loss in terms of units, expected output. E ni scrap value. Then this one here, total cost of input. Is it clear now? So to avoid these many stories, I want us to have a format. I want us to have a format and see how we are going to prepare this account. And for us to understand what is going on, we should be able to go to ATD 2023. ATD 2023, we will be able to see a question from that particular topic. We need to move very fast, go straight to the point. So let's go to ATD 2023, ATD 2023, question number, let me see if I can get it here very fast. Those who have it, you can share it in the group there for the benefit of those who are joining for the first time. For the benefit of your friends who are joining us for the first time, please do them that favor. August or April? August, the last sitting. The very latest paper that was done. Let me see if I have it here. Hiyo ya August ndio tunaangalia. Someone can share it in the group. I can't find mine. Someone to share it with us. Someone to share it with us there. Tunaweza iona kweli? Someone to share it with us. I'm only able to see April, really. August 2023. August 2023. Do we have it now? Do we have it now with us? Do we have it now with us? If not, then I've done so. I've shared it in that group. So watu wachangamke. So let's look at August 2023. Question number 1B. Question number 1B. August 2023. ATD. Question number 1B. So tuko hapo. Are we together? Are we together at that point? Are we together? List 4 examples of costs that are relevant for decision-making process. Hiyo iko kwa ile document. The costs that are relevant for decision-making, if I want to make a decision of either doing manufacturing or not, I must look at some costs which are constant. Whether you like it or not, you are going to pay rent. So rent will not affect your decision on the fixed costs that are there. And of course, we'll be able to check that. So let's see. We are told that a product is manufactured by passing it through 3 processes, namely process 1, 2, and 3, respectively. For the first week of July 2023, the actual data included the following. So you have process, normal loss of output, scrap value per unit, output in units. Direct costs, we have direct material added in the process, direct labor, direct expenses. Okay, so what do we need to have in place? This is the format. I'm going to do process 1, and from that point, you are going to learn a lot of things. So our process one, our process one will be having this particular format. We have units, we have cost per unit, or sorry, we have units here. We have cost per unit, and then we have amount. Then here we have amount, cost per unit, we have unit, and then we have particulars or details. So this is what we call process one. I'll do the same thing down here for me to move to process two. So down here, you'll be able to have details, units, cost per unit, amount, details, cost per unit or units, cost per unit, then amount. So we have details, units, cost per unit, then amount. Details, units, cost per unit, then amount. Now, having done that, remember we have been given that in process one, this is the procedure. We are bringing in raw material. So the raw material here, we have direct material, and the direct material here, remember what I said, when we are bringing in timber, we said we need 50 feet. But when we brought in nails, we only given the amount. So this one here is not the main raw material. The main raw material is the timber, which you're going to use in doing what? In making up the table. So here also, we are able to see the direct material. We have been given the units of 6,000 and the cost is 12,000. Everything is in thousands. So the cost here is 12,000, which means we can get the cost per unit as 2. After having the direct material, you're able to see we also have another material. This material here, we can call it indirect or direct material added in the process. You just give it that name, direct material, the way they have said. But we are not given the unit. So we are only going to use the cost of that material as stated there of 5,000. After that, we have direct labor of how much? Of 4,000. Then we have direct expenses. Direct expenses of how much? Of 1,000. Are they giving us anything about the overheads? Additional information. They are telling us that budgeted production overheads for the week is 30,000 and are absorbed based on direct labor cost. That is for the entire week. Then budgeted direct wages for the week amounted to 1,200,000. So it is again taking us back to this concept, which we've been learning all along. Overhead absorption rate. Overhead absorption rate is equivalent to budgeted overheads. Budgeted production overheads for the week is 500,000. We divide by budgeted activity level, which is direct labor wages. So the direct labor wages here budgeted is 200,000. Can someone give us the overhead absorption rate? So it will be shillings per direct labor cost. Somebody to do this and give us the overhead absorption rate. Somebody to do that, somebody to do that. Tutakuwa na ngapi? 3,500 divided by 12,200. Tutakuwa na ngapi? So we're going to have shillings 2.5 per direct labor cost. So we have direct labor. Direct labor is already given there. So we want to bring in the overheads. Overheads, we have been told, is 2.5 shillings per direct labor cost. So can we take 2.5 by direct labor of 4,000? Tunapata ngapi? 2.5 by 4,000. Tunapata ngapi hapa? 10,000. So by doing that, we've added all the input costs. We've added all the input costs. Then if you go to the information given to us there again, we are told the output is 5760. This output is going to process 2. So I indicate here process 2. The actual output is 5760 units. I do not know the cost. I need to calculate that. Whatever is going to process 2, remember we were told that the normal loss tuliambiwa ni ngapi? For process 1, the normal loss is 5%. 5% of the input. 5% of the input. So can someone give us 5% of the input, which is 6,000? 5% of our input. 5% of our input ni ngapi? 3,000. No, you are lying to me. Remember, this is 6,000 units. 6,000 units. So 5% will be 300 units. We expect to lose 300 units under normal circumstance. But here, the cost per unit of the normal loss, we have been given there as the scrap value of the normal loss. What is the scrap value per unit of the normal loss in process 1? What is the scrap value per unit of normal loss in process 1? Are we able to see it there? Scrap value tunaona hapo ni ngapi? 1.5. So that's what I bring here, 1.5. 1.5 by 300, utapata ngapi? 1.5 by 300, unapata ngapi? 450 shillings. 450 shillings. Okay, having done that, we now need to understand, are these accounts balancing? The units must balance, because if I brought in 6,000 units, even the normal loss taken care of, I should be having the same number of units. Because as we advance, we are even going to look at the closing inventory or work in progress, the closing work in progress. But as at now, we don't have that. So I brought in 6,000 units. I'm expected to lose 300, and I've transferred 5760. So 5760 plus 300 should give me a total of 6,000. How to get normal loss? Normal loss tumeambiwa ni 5% of input. 5% of input of units, not the value of units. No, it is 5% of the units that were brought in. To later, how many units? Units that were brought in there. Are you able to see direct material? 6,000 units. So what is 5% of 6,000 units? Florence, what is 5% of 6,000? What is 5% of 6,000? Unapata ngapi? 300, ndio hii. And the scrap value per unit of the normal loss is 1.5. If you multiply, you are getting 450. How is process 2, 5760? Process 2, if you are in the manufacturing sector, at this point here, you only boil. Having boiled, you transfer to departments ingine that they're going to add in some chemicals. That is process 2. In process 3, if you come to process 3, they have added everything. You are now have the finished product. Whatever you are having there as the output, it is there. In process 1, we are done with it. 5760 is given there in the question. Look at outputs of process 1. Look at outputs of process 1. Before we go to whatever is not balancing or balancing, tunaelewa hii part yote sasa. Are we understanding something here? Iko sawa. There's something that I've not explained which will help you understand what is going on. Are we okay with this part first of all? So if you add this, you are getting 60. You are getting 60. You brought in 6,000. Is it? The normal loss we have been told here is 5%, which is 300. So if you brought in 6,000, normally you are expected to lose 300. So you are going to have 5,700 as what's supposed to be transferred to process 2 under normal circumstances. It happened that you did not lose the 300. How many units did you lose? Ulipoteza ngapi? 6,000 minus 5760, which was transferred to process 2. Itakwambia you lost less than this. Is it? You lost less than this. So you are very keen to an extent that you did not lose the normal units. Is it? So you're supposed to lose 300, lakini ulipoteza 240. So what did you receive? Uko na gain, is it? The company has got a gain of how many units? Ako na gain ya how many units? That is not a usual gain. It is abnormal. It is abnormal gain of how many units? Of 60. Are the units now balancing? Are the units now balancing? Are they now balancing? Are they now balancing? Good. So we are going to stop at this point, but I want you to do me a favor. Go to topic number 6. Watch at least the first 2 videos. Just watch the first 2 videos so that when we meet on Friday, you'll be just mentioning these things as I do them. Watch the first 2 videos and even you'll be able to complete this question here. Just the first 2 only at a speed of 1.5. When we meet on Friday, I'll be finding most of you already having the scheme for this particular question. So I would like us to stop at this point. There's another class that's about to start.